and then we can, I don't know how you want to do it, David. Do you want to do the presentation first and then allow questions at the end? Or do you want to take questions as you go along?
I can do the presentation and then we can have the questions at the end.
Okay, fine. So we'll try to keep the presentation to about maybe 40 minutes or so that we allow 20 minutes of questions. Is that fine?
That's perfect.
Okay, yeah. Over to you, David. Thank you.
Yeah, thank you so much. And thank you everyone for hosting me. As was mentioned, my names are Davy Nanduba. I'm a licensed investment advisor. So just to set the record straight, our conversation today is nothing around get-rich-quick schemes. It's purely professional. We'll look at the options we have in the market. We would test those options in a later part of the presentation. We'll use two scenarios, assuming we had 200 and 500 as capital, and we place this into different markets. What sort of returns would we make and what are the risks associated? So there'll be this session that will be very detailed, and I'll ask all of us to participate and just follow through, as the information that will be shared it's both basic but practical, so that we can be able to apply what we cover in this session. So just to get started, I will share my screen. Okay. Are you able to see my screen?
Yes, we're able to. Thank you.
Yes, we can see it.
Okay, perfect. So the title of the presentation is Securing the Future. And if you notice below there, we are saying the best financial version of yourself. And you know, we start with asking a question, are we ready for the future? This is very important because the future does not happen. We have to put in place certain things to ensure we can live through the future with very little challenges and difficulties. We've seen people who've earned income. They haven't utilized that income the most efficient way they should. And down retirement, you find them struggling. And the reason could be they were not ready for the future. And the future does find us. And one thing that is guaranteed is that as long as you and me are alive, we will certainly be part of the future as it happens right now as we speak. And some things to consider is, you know, if your employment was terminated, you know, do you have enough savings to survive? How long would you and your family survive? Are you ready for tomorrow? That's extremely important for us to know. There was some research that was done, and this research concluded that out of 10 people who retired, you know, 49 of them became dependent on family and charity. 29 of them died. 12 of them became broke. 5 wanted to continue working. 4 of them were financially independent, and 1 of them became rich. So out of 100 people. And the real question is, where would we be amongst these statistics? Which group of people would we be part of? So it's critical for us to have a view on the future, you know, because the experiences we have on the future to a large extent depend on whether we have a plan or not. And this future could look something like us working, continuing to work. And we know that as we age, our strength diminishes. And what we are left with are the assets to support us, because using our own labor, we cease to be, or we stop being as useful as we were when we were young. So we can't do much. So what tends to support us as we get older are the assets that we have accumulated that are funding our lifestyle. Or are we going to be living in dream houses, our dream houses? Are we going to be driving luxury cars? Are we going to be traveling the world? Are we going to be running a business? So depending on how we view the future, this would determine what kind of plan we put in place today. And this plan should take into account what's happening right now in the economy. That the perspective is important. And just to highlight a few things that are happening that should eventually speak to what we talk about as we get down the presentation is, the prices of goods and services are increasing in the market. So the things that you could buy for 2,000 in January, you perhaps are spending 3,000 or 4,000. So are we earning enough, or are we placing our cash into instruments that can hedge inflation, which is simply the rise in prices? Are we making those decisions? And we'll talk about this in more detail as we get through the presentation. We've got power shortages that are happening in the market, which is affecting productivity for individuals and businesses. Job losses as businesses shut down, people are going back home. Increasing pressure on the kwacha, which is a big one, and I'd like us to focus on this through the presentation and just see the impact that this can have on the decisions that we make. So, the kwacha is being pressured due to low copper prices, inadequate supply of dollar on the market, and coronavirus-related problems. But just to put the purchasing power of the kwacha into perspective, is if you consider yourself 5 years ago and you had 100,000 kwacha, at a rate, so below I've shown the rates, the buying and selling rates of the kwacha from 2015. So in 2015, if you had 100,000 kwacha, you should have been able to purchase dollars worth 14,286. 5 years down the road, you can only purchase, $5,439. So the kwacha has lost 62% of its value. So you can imagine saving something that's losing 62%. So what this means is, if you're going to invest in kwacha, you should be looking at achieving returns above 62% to just hedge inflation, the real loss of value of the currency. So when we test the kwacha's ability to store value, clearly over the past 5 years, it's shown that it does not have very good capacity to store value. It's losing value. And so what we should then do as we run through this presentation is ask ourselves, where should we be investing our cash? Where should we invest our money? Where we can save and preserve value. And that's extremely important. And we'll look at those as we get down the presentation. So having said that context, what is important then is to empower ourselves with knowledge. Knowledge is very important. I like a quote by Martin Luther where he says, there's nothing in the world that's more dangerous than sincere ignorance. So there's no excuse for not knowing. When the opportunity is presented, as it has in this case, we need to empower ourselves with knowledge. Even beyond this presentation, we need to read literature around finance, just to make sure that we have the right knowledge with regards money, which is the money language. So it's important for us to invest in that education and ask ourselves, what are we doing with our money? Are we investing the money, or are we consuming everything as we earn it?
Hello.
Hello? Hello? Hi, Malule. Hello?
We can get you.
Okay, perfect. So we need to ask ourselves, what are we doing with our money? Are we investing this money? And what exactly are we investing in? Are we using this money efficiently? What are the risks we are taking with the money we are placing in, or the products we're investing in? And what are these options? So this is what we will look at through the presentation. So let's get started. I think that was an intro. Now let's get started and get to the business for today. So investing is the process of spending money to acquire assets that have the potential to appreciate in value and pay you income by owning them. That's important to note. So the more technical definitions you'd find if you browse the internet are the ones I've placed at the bottom, which is spending resources or money with expectation of making a return, or with expectation of achieving a profit. So the one I've crafted is the one just below the question, which is, it's a process of us spending money to acquire assets. And these assets that we acquire should have the potential to appreciate in value. And by holding on to these assets, which is owning these assets, we should be able to get an income from that asset. So very important to note is that some assets will only appreciate and will not pay income. Others will appreciate and they will pay income by owning them. So the real question then is, are we spending on assets or are we spending on liabilities? And put simply, assets would be those things that have the potential to appreciate or pay us income. And liabilities would be the things that make us spend more money on them in order for us to maintain them. So it could be a car, it could be a house that we live in. But the real measure from an investment point of view is whatever we've acquired appreciating in value, that we can sell it off for profit more than we purchased it for, or is it paying us an income? Or does it simply drain us? So every month we have to spend on it, buy fuel, buy parts, service and so on. As much as, it may be useful as transport in the case of a car, but we need to strike a balance between assets and liabilities. And for the purposes of this discussion, we must be clear that assets are things that have potential to appreciate and we can cash them out for a profit, or we can earn some income by holding onto the asset. To acquire assets, there's risk. Remember, investing is a promise that you make some returns or some profit or some form. And that promise can be broken or it can fail. And that's where the risk is. So before we look at individual products that are available for us to put cash in, it's important for us to understand the product. So risk doesn't mean, if something is risky, it doesn't mean we should avoid it. It just means that, we need to understand it better. So how does this product make money? What are the risks associated? What's the likelihood of these risks crystallizing? How quickly can I get out of this investment if I wanted to cut my losses? So risk depends on the product that you're investing in. And most important to this conversation around risk, so look at different products. I want us to apply what we've discussed so far on individual products, then it becomes more meaningful and relevant. But important to the discussion of risk is that everything in life carries risk. What is important is to manage the risk. So whenever someone presents an opportunity to you to invest, the question you should ask is, what can go wrong, which is the risks, and how is this managed? If it's not managed, you will lose money. If you don't understand how it operates, you will lose money. So you need to be clear with the product structure, how the product operates, and what can go wrong if you put money into that product. So there are several options on the market. Some of these options include real estate, stocks, which are shares in companies, bonds, treasury bills, mutual funds, commodities, which would be your gold, your copper, your soya, business, entrepreneurship, or currencies, investing in currencies. Now, this is quite a lot to cover, and I've left out some products that are available. But what I will focus on, are a few products that are relevant to us and for us to get started. And in a future episode, we can look at more sophisticated and complex products, but which also pay returns, good returns, but they're more sophisticated and need a bit more time to understand how they operate. So I guess the question you'd be asking is, which option is right for me? Having looked at those many products that we've just covered in the previous slide. So the decision is based on your financial goals. That's critical. You must have a goal that you're working towards. Are you trying to achieve early retirement? Is it financial independence you're looking for? Is it business ownership? Are you trying to preserve the value of the money you're earning? Are you trying to save for your children if you have some? So that goal will determine to a large extent what vehicle, and in this case, the product you will use to get to that goal. Another thing that's critical to consider is, how much cash capital do you have today? It's very important for you to create wealth, for you to buy assets. You need some existing assets, and the asset can be cash itself. Cash is an asset. So you need to check, how much do I have and what's the minimum in the products that I want to invest in. That's important to note. You also need to look at the risks, and we covered this, and we'll look at this in more detail. What risk are you willing to take? There are some people, when you speak to them, they'll tell you, I'm not willing to take any risk. If you're not willing to take any risk, it is difficult to make money. Everything, like I mentioned before, carries risk. What is important to know is how is that risk managed? And another important part to look at is, how long should you be invested? Is it 2 years, 3 years, 4 years, 5 years, or 10 years, and what are the costs involved, the taxes applicable? So these different factors will determine where you put your money or which product that you choose. So let's get started. And this will be a hands-on session from this point onwards. We will look at different products. We will assume we have the capital. We will place the capital into the products. We will see how the products generate returns. We will see what the risks are. And based on that, at the end of this part we're getting into, we'll do an assessment of the different options. So land, real estate, stocks, shares, treasury bills, bonds, mutual funds. Which one is, how do they perform? And I think this is extremely valuable. This part we're getting into, I would ask all of us to really follow through closely, because it involves numbers. We'll look at some numbers, but it's extremely important with the efficiency with which you make your investment decisions. You can be making investment decisions, but they are very poor decisions because you are not using your money efficiently. So knowing how different products operate, how they perform, can help you make as much as you can from the income you're earning today. So let's get started. This is a scenario. So scenario setting, we'll be investing in real estate, we'll be investing in shares, we'll be investing in bonds, we'll be investing in mutual funds, we will start a business. From a capital point of view, there are two scenarios that I would like us to use. One is that we've got capital of 200,000 kwacha, and the other one is that we've got 500,000 kwacha. So the only reason I've used 500,000 kwacha for the second scenario is because I want to put into perspective investments in real estate. And most of us would be looking to build houses if we're not already building houses. And at least at a minimum, we'll be looking at 500. I guess we could spend more, but just to put it into perspective. And please don't miss the point. The point here is just perspective on the performance of the product. So 200K and we have 500,000. The time frame we'll be working with is 5 years. Investing, if you do anything short term, it will be classified savings. You must be looking 2 years, 3 years to invest. Long term is very important when it comes to investing. Again, here, the only reason we're looking at 5 years is just to illustrate the returns, assuming we invested for 5 years. So we need to get back in time to 2015. If we're having this conversation in 2015 and we're reviewing the performance today in June, how would the returns look? What kind of profits would we have made, and so on? And just putting into perspective and context, would have looked at the performance today and taken a position in the future, but that would have been very difficult to appreciate the products in reality. So that's why we've gone back in time. We're saying we're in 2015, and then we evaluate the performance today. So that today, when we make these decisions, 5 years from now, we should look back and look at the decisions we made today. Very important. Then we'll also look at risk and returns, so what can go wrong and what kind of returns can we get from the options that we've listed above. So to start with, we are going into the property market, and we are starting with our 200K. So in the property market, I need to be sure there's quite some content to cover here. But I have to make sure, and if I'm too fast, please let me know. I need to make sure that all of us follow through this section very closely. So in the property market, it's simply, a market is a place where you buy and sell things. So in this case, property market is where we buy property, and the assets within this market can be land, or it can be rental property, commercial or residential. So commercial, we lease it out for business. It could be a warehouse or something like that. Residential is flats. We put people there to rent, and they pay us rental income, which are the returns you expect from this market. So there are two types of returns. It could be rentals, or it could be appreciation in value, and you should sell. The risks associated with property investments are that the value can appreciate or depreciate. And I think many people in Zambia will tell you that property appreciates, it does not lose value. And we will test that as we go through the presentation. We also need to consider that land can be repossessed or it can be encroached, but I guess those risks are negligible and they can be well managed. So as much as they exist, they are very low. And that's why people say property investments are low risk. It's for that reason. I guess one of the other risks could be, it can catch fire, but you can manage that with insurance. It's easy to do that by just taking a policy cover, so that if your building is burnt or your house is burnt, insurance compensates you for that. So let's start with scenario one. And this is a real scenario. It's not made up. It's a real scenario. So in 2015, one of my colleagues was presented with an opportunity to buy land in Ibex. And he bought this land, a 30 by 50, for 200,000 kwacha. In 2015, the dollar to kwacha was costing $1 was equal to 6 kwacha. This is real. In 2020, the same piece of land is worth 300,000. So the neighbor, his neighbor was offering, so his neighbor was offering their land. There was no building on it. And they sold that piece of land this year for 300,000 kwacha. So just there, in 2015, the value of the land in dollar terms was $33,000. In 2020, the same piece of land is worth $16,000. So half the value has been lost. And the reason why half the value has been lost is that the currency's ability, and this is what we tackled in the beginning, the ability of the kwacha to store value is weak. And so it has lost value. So the property in real terms, in kwacha terms, has appreciated by 100,000 kwacha. If we review the investment, just the land, it's appreciated by 100,000 kwacha, which is $55,000 in 5 years. So this is a period of 5 years. And in dollar terms, it's lost, 50%. We'll come back to this when we review all the investments. So we'll come back to this. So just take note, we'll come back. I'll show you a table where we'll put this in clear view with, benchmarked against other investments. But just take note that if you bought land in 2015, you spent $200,000. In 2020, that land is now worth $16,000. You would have lost 50% of your value from that piece of land that you're holding onto. So someone who was holding onto dollars is in a better position than you who just held onto the basic land. Very important to note. We explain that more as we get down. So option 2 within the real estate market, and is the reason why we went to the 500K, was that if we invested in 2015, 500,000, and let's follow through closely, we bought land, 150. We built for 350, very conservative numbers, would obviously be spending more, but this is 2015. We can assume that we built in 1 year. So I want us to be as optimistic as we can on real estate so that we don't disadvantage the asset. So we built and we spend a total of 500 on land and buildings. We're optimistic that in 12 months we finish building. So And we're very optimistic that on the 1st of January, we place someone, into the house to rent. And in 2016, we'll be collecting rentals worth 3,800 kwacha. So it means in 2016 itself would have collected rentals of 45,000. This is what I'm showing in the corner there in the section that says rentals. In 2015, you would have collected 48,000 kwacha, 2018, and we're very optimistic, we're increasing rentals. In 2018, we've increased our rentals to 45, we're getting 54,000. In 2019, we've increased rentals further by 5,000, we're getting 60,000 a month. In 2020, we increased rentals further by 500 kwacha, and we are collecting 33,000. So in total, the rentals we've collected are 240,600. The point to note is the total. So as at June, so 6 months, if you notice 2020, I'm saying 6 months, that's up to June. So as at June, in total, rentals that we've collected are 240,000. We are very optimistic that we're not even assuming that there are periods of vacancy where the house is empty. But this is good. So I want us to be as optimistic as possible in real estate so that we don't disadvantage it as we get to other assets, as would be seen. If we review this investment in the house that we've purchased and we're proud of and that we've put on rent, the property has appreciated by 600. So the market value now is 1.1 million. So if you go into the market, it's 1.1 million for the same house, which is good. So in dollar terms, it's about $61,000. Rentals that have been paid out are 240,000 kwacha. So if we're to check a summary on the two assets within the real estate market, which is the land and the house, with the land, the value of the land has increased from 200,000 to 300,000, which is a capital gain. So that difference, we call it a capital gain. The gain on the capital, because the capital we put in was 200,000, the gain is 100,000, and the property is now worth 300,000. The house, we put in 500, and it's gained much. It's gone up to 1.1 million. The gain itself is 600,000, and we've been able to get income from this asset of 240,000 kwacha. Total return, taking into account the gain and the income, is 840. Now, something you will notice here, and I'll talk more detail. There's a column for dollars at the end there. You can forget about it for now. I'll talk about it as we look at the other products. But something you will notice on real estate investments is that they are very good when it comes to appreciation in value. That is important to note. And appreciation in value is capital gaining. So if you are going to invest in real estate for rentals, in a market where the prices have really spiked up, you may not get your returns, but we'll put this into context as we go to other products. I'm quite keen to make sure that we get into discussions and questions are asked, but let's look at the other products so that we can look at these things in perspective. So the key highlight here is that you will notice that when it comes to rental payouts, it's not as much, but it's very good at storing value. So if you're trying to keep value, if you're trying to move money away from the kwacha, which is losing value, kwacha, remember, is an asset also. So cash is an asset. So if you want to store value, real estate is a very good option for you to transfer value from paper money, which can be printed, into real estate, a building. The value will be better preserved than if you just kept it on account with a bank. Let's get to another product, shares. And just take note again of these figures, remember them as we get to shares. So shares represent ownership in a company. So you can invest in a company by buying shares in it. And technically what you're doing is that you're buying a piece of that company, you're becoming a shareholder of that company. When companies want people to buy shares in them, they may have to make the companies public. That's not important for the discussion, but it's just good for us to be aware of that. But what's key here for us is we're looking at this from the context or perspective of an investor. So we are becoming shareholders. When we become shareholders or when we buy shares in companies, there are two things that we expect the company to deliver to us as returns, promises that they should make to us. The first is that they're going to share their profits with us, and we call this a dividend, or they will appreciate the value of the shares that we hold. So the shares are going to increase in value, which means the company is going to perform well, the market is going to like the way the company is behaving or operating, and there'll be demand for their shares. And because of that demand, the price of the shares we're holding will go up. That's what we expect in an investment in shares when we invest in a company by buying their shares. What can go wrong with share investments? Like we've mentioned, the price can go up or down, the value can fluctuate, and dividends may not be paid out. That's very important to note. So your dividends may not be paid out. They are promised, but they may not be paid out. And the value of your shares, if you buy a share for $4, it can go up to $4 or it can drop, as has been the case of CEC and those who invested in Madison. The shares dropped. But there's something important I want you to notice here. You've got access to more active markets, which would be your international stock markets. So if you had invested in Amazon, some figures here, but let's walk through closely. Same figures and same scenarios. Something very interesting happens here. So we're back in 2015 and we want to buy Amazon stock. Today you can actually buy Amazon stock. You want to buy Amazon stock. And so the first thing you do in 2015 is to convert your 200,000 kwacha into dollars. So in 2015, when you convert your 200,000 kwacha, you would have made $33,000. If it was 500,000 kwacha you had and converted it to dollars, you would have made $83,000. The next thing you would do with those dollars is buy shares in Amazon. And one share in Amazon at the time was costing $308. $308. That was the cost of buying one share in Amazon. So in the first scenario, with your 33,000 kwacha, you would have bought 108 shares in Amazon. The percentage is not important. Forget about whether you're a 2% shareholder, 5% shareholder. It's irrelevant at this point. What's important is how many shares do you own in Amazon. So you own 108 shares. If you had 800,000, which is scenario 2, the 500K, the number of shares you would have purchased are 270. Step 3, you would have simply waited for management in Amazon to do their work, run the company well, and increase the value of the company. So step 4, which is 9, so the prices here, when I say 19th June, it's literal. This was a Friday. So Amazon's price as at Friday, the share price has increased to 2,674. So as an investor, at this moment on Friday, what you would have done is gone to a broker, offloaded your Amazon shares, and if you had offloaded your 108 shares that you had bought for 200,000 kwacha in 2015, you would have made $289,000. In kwacha terms, today you would have made 5 million kwacha, 5.2 million kwacha. From an investment of 200,000, you would have made 5 million kwacha had you invested in Amazon shares. And I'm not using Amazon as a out of reach company. You can actually invest in Amazon today. Had you had the knowledge on how to access this market and these, the stock market, the offshore stock market, you've got access to Amazon shares. So 200,000 increases to 5 million. 500,000 in the same period of time increases to 13 million kwacha. So you can imagine in the real estate example, our 500 had increased to 1.1 million. In Amazon, it would have increased to 13 million. Our 200 on the piece of land had increased to 300, and we're very proud of ourselves because we're owners of property. But in Amazon, it would have increased to 5.2 million. you can then afford to buy more property if you started with the stock market. So again, an important point here, I need to be keen, time, we don't have so much time. And an important point to note here is which asset is good for what. That's very important to know. So if you're trying to grow capital, the stock market is the best place to grow capital. If you're looking for income payouts, if you notice here at the bottom, I've put that no dividends have been paid by Amazon. So if you're looking for income, your real estate could be better, but when it comes to growing value, growing money, stock markets are better. And to be very clear, we are talking about the international stock market and not our local stock market, which is not so active. And so prices do not move as much as we are seeing in the case of Amazon. That is very important to note. So if you're going to invest in our Lusaka Securities Exchange, and I'm not watering down the stock market in any way, our local stock market, but of course, stock markets are driven by activity, and there's not so much activity. We are making strides and getting to a place where there'll be activity in the stock market, but you can't see such returns in the local stock market as compared to the international stock market. That's important to note. So in summary, this is what we've covered. We'll come back to this summary. So don't worry, 200 increases to 5 million, and then, your 500 increases to 13 million. So your profit there in the second scenario is 12.5 million. In the first scenario, it is 5 million flat. It's very good numbers to look at, but it's the power of knowledge. So let's look at another asset. Because of time, we'll come back to this. Bonds represent contracts. When you buy a bond, I think we've heard bonds, we've heard people talk about bonds. So a bond is a loan. You're simply getting yourself into a loan as an investor that entitles you to receive some regular payments. And normally these would be every 6 months, and to receive your principal at maturity, which is your investment amount. So typically what you'd be looking for as an investor in bonds is a regular stream of income. In other circles, technically, it would be called a coupon, but it's just interest payouts or income you're receiving. And you're also looking for the value of your bond to appreciate. This is very important, that whenever you're looking at an asset, that asset should have the ability to appreciate. So you want your bond to appreciate. What can go wrong when it comes to investing in bonds is that, because it's a loan, the person you've given the money, whether it's a company or the government, can default. Or when you want to offload your bond, no one may be available to buy it, which is liquidity risk. Technically, that's what it's called. But what it is simply that when you want to offload, there may be no one to sell to. And the currency that you may lose, so currency risk is simply that you may lose value if you're investing in a weak currency, which is as we've looked at, we've seen that the kwacha when we started lost almost 62% of its value. So very quick here, from an illustration point of view, and I'm keen again to make sure that we work through in the time that we have. So I'll highlight the key aspects. I'll share this deck so that you can read through and just take time to go through these numbers. But what you will notice here is that over the 5 years, you would have made 245,000 kwacha. Your capital would have grown. Let me show you the summary table. You can look at the details later. But what's happening is that in the first scenario, your 200,000 kwacha would have grown to 350 if you invested in a bond. And the gain you'd have made in that case, just on capital, would have been 150,000. In terms of income payouts, you'd have got income payouts of 245,000 kwacha. If you put in the 500,000, the value would have grown to 877,000 kwacha. You'd have made a gain of 300,000 and received income of 614. So again, a point here to highlight, it's something you look at when you look at this deck after the session, is that when it comes to income payout, bonds give you the value faster than real estate. So if someone is in retirement or is looking to retire, the asset they should be looking to put money into, if they're looking for a salary, a replacement of a salary, is a bond and not a house. Because houses, as we've seen, are very good at storing value. So in a market like Zambia, where people say we don't sell property, it is very strange then that you would make good returns from a property investment. it simply means if you won't sell your house, then you have to make money through the rentals, which is income. And which asset pays better income? A bond would pay better income than a house. But over the long term, a house would appreciate faster and better than a bond. And that's why assets should be looked at in context. Mutual funds is another asset that we should look at. It's a collective investment scheme. So basically, put simply, mutual funds are pools. It's a pool of investment. So different people pool money together, and then you have a manager who comes up with a strategy on where they're going to invest this money. So they can invest it in stocks, which are shares. They can use it to buy bonds. And then based on the performance of those bonds, if they've bought bonds or they've bought shares, you share the profits as shareholders. That's how a mutual fund works. So when you're invested in a mutual fund, you need to be sure that the person who's managing that fund, which is if you're collective, village banking is a form of a fund, because you're pulling money together. You need to make sure if the person is investing that money on your behalf, they are competent to make you money. That's very important. The returns you'll be looking for are the same like shares, which is the growth in the value of the units you buy, or dividends, from the units that you hold. What can go wrong? Same thing like shares. Value may fluctuate, it may go up or down, or you may not be paid dividends. Here, let me illustrate something. This is a fund over 5 years that I know several people are invested in. This fund that's being displayed here. It's called a technology fund. With this fund, it doesn't pay any dividend, so it simply just grows capital. So your interest as an investor is what was the price 5 years ago, what is the price today? So if I put this in two numbers, you can work through the calculations, but let me just get to the summary of what happened here, is that if you invested 200,000 kwacha into this fund 5 years ago, today that 200,000 would be worth 1.5 million kwacha. If you invested that money, if you invested 500,000 into this mutual fund, today the value of that 500,000 would be 3.8 million. It simply means with 3.8 million, if this is where you started from, you can buy more property. You can buy more property, you can buy more land. So to compete with everyone who's rushing for land with a depreciating kwacha, you may not compete favorably. You may need to start with an advantage, which is in a different asset, grow your money with that asset, catch up with the market, because the real estate market in Zambia is not moving as fast as it should. Remember, the property for 200 only increased, the land increased from 200 to 300 in 5 years, But here you can grow it to 1.5 and then come back and buy more land. So smart decisions like that can make the difference with how we use our cash. Business entrepreneurship, as we wind down, we're getting to the end of the presentation. What I wanted to highlight here is that there's so much hype around business. And I must categorically state that not everyone is meant to start a business. You can participate by buying shares in a business or partnering with someone, but not everyone is meant to start business. That's important to note. So we shouldn't get into the spell or delusion of motivational speakers and telling us just start a business and so on. If you have the calling, you have the talent, you have the expertise, you should do it. But if you don't, you can make smarter decisions by investing in already established businesses. What is sure is that from a potential point of view, the most potential when it comes to any asset is made in business. Even your bonds, your shares, you're buying those in businesses. So from a wealth creation point of view, the foundation of wealth creation is in businesses. The decision you need to make is whether you are going to start your own or you're going to invest in an Amazon. And starting your own, like I put in this next slide, there are several considerations to make. If you're not going to sell that business or make it go public, then it's going to be hand to mouth and you waste so much time trying to get the business running. But you remember again, a business stores value. It's good for storing value. So if you never cash out that value by selling the business, then it will be hand to mouth. and it will go nowhere. You would have spent so much time, so much energy, and the business will shut down. You need to consider the competencies required to run that business. You need to consider the environment you're in. You know, if you're going to be selling in Kwacha, how are you going to make sure you remain competitive and you don't lose value? What are you investing? Are you investing time, money, expertise, and so on? You need to make sure those things are very clear. If business is exciting, it's fantastic, it is great from a return point of view, but like I mentioned before, if you're not going to sell it, which is to cash out the value that has been stored in that asset, because the only way you cash out the value stored is by selling something. So if you're not going to sell, then you may want to invest in an already established business or partner with someone who is invested in one. So quickly, as we wind down, let's review our options in this table. So if we invested in land and we did it in Kwacha, in all of these, remember, we're putting in 200,000, would have bought one piece of land, the land would have increased to 300,000. If we put it in a bond, the bond would have increased to 350. If we put it in a mutual fund, it would have increased to 1.5 million. If we put it in Amazon or in shares, and remember, different companies perform differently, so please don't use Amazon as the benchmark for returns. You need to speak to an advisor who can advise you where to place your funds, into which companies and sectors are doing well. That's very important. But this is just to show you the potential of different products. So if you put it in Amazon, like we've seen, you would have made 5.2 million. In terms of returns, which is the last column, that piece of land, 200 to 300, it's 50% growth. It's good. It's better than zero. If you put it in a bond, it would have increased 198%. That's the return you would have made. If you put it in a mutual fund, in a period of 5 years, you would have made 670% return. These are real examples. They're not fictional. They're not imagined numbers. These are real live examples you get from the market. If you put it in shares, in Amazon, that was the example we used. It would have been 2,600%. Same thing, if it were 500,000, the principles apply. Our 500 in the house would have grown to 1.2 million, or even perhaps 1.3, if we're to be modest, even 1.5, if we're to stretch it, you know. Imagine you could sell your house that you put in 500 for 1.5. That would still be good. It'd still be decent. But the question you should ask yourself is, are there any assets on the market that can help me generate better returns for the same amount of money? So in the bonds, it will have increased to 800. So what you notice is that the bonds are not very good at growing money. Real estate is better than the bond. But mutual funds that are invested in shares are far much better than the house, because they can grow the same 500 to 3.8 million, which is this 3.8 million here. Shares can grow the 500 to 13 million. So remember here, the key thing is more about the decision to where to place money. And to place money, you need knowledge, and which is what you are sharing here. And I really hope that we take this information personal, and that we make the most efficient. And remember, I'm not using the word right, because what's right can be different for, you know, and for different people. The word I'm using is efficient, you know, because a 200,000 kwacha can give you a 300, or it can grow to 350, or it can grow to 1.5, or it can grow to 5. But the risk also speaks to that. You can also lose the same money by the same quantum. So that's why I said you need to be sure, you know, what assets do you have? What risk are you willing to take? What objectives are you working towards? What is the length of the investment period? What is the cost of investing? You know, what taxes are applicable? What method are you going to use, lump sum or regular? Or, you know, what knowledge do you have? You know, because you can't invest in something you don't understand. You need to understand how that product makes money. So in conclusion, let's act today. Nothing happens by itself. The future is here. And in 5 years' time, we'll be looking at each other, and the salary that we earn today will be remembered when it's cut, or when we get to a point where our energies deplete. And what would be so painful is to have a presentation like this done at age 60, because you'll be asking yourself, why didn't I know this before? I would have made better decisions with my money. So there's no such thing as a right time. Today is the right time. Speak to an advisor. So thank you so much for your time. I don't know if you've got any questions. I'll hand over back to Malilwe so that you can pick it up from here. I just hope that the information we've shared today is valuable and that you take it personal and that you can use this in your personal life.
Thank you very much, Davy, for that presentation. As a way to just probably kickstart the discussion in terms of questions, I think there are a few things that guys have posted in the chat box. So the first one is talking about challenges in buying international stocks. Do you require a broker for that? The second one is saying, shed more light on coins and cryptocurrencies. So, what are the risks involved and benefits, if any? And then the last one is asking whether there is any bonds, any accessible online resources one can use to look up, available stocks and bonds, both locally and internationally. So I'll allow you to tackle those three. And then I think for the questions, we'll proceed in such a manner that if you want to ask a question, you can raise your hand, and then we can call you out to minimize confusion, so that when I call upon you, you can ask your question, or indeed you can use the chat box. So Davy, maybe you can tackle those three, the first three from the chat box.
Okay, sure. Thank you so much for those questions. So the first one is, do you need a broker to access the international stock market? Yes, you need a broker. There are several brokers and several companies in Zambia that you can speak to that can connect you to these stocks. And I'll avoid to mention them here, considering it's recorded, in case, since we don't have permission from those companies to mention them. But the short answer is yes. Even after this call, we can have a conversation, we can chat one-on-one. I can show you the resources that you need to access the offshore stock market. You can access these markets very easily. And there are also companies in Zambia that can give you access to these companies. Important to note, I think, which all of us should appreciate, is that for the stock market offshore, you'd normally be accessing this through an online broker. Locally, what you get access to are the mutual funds offshore. So outside this conversation, if you need more information, you can reach out to me, and then I can show you how you can access these markets. The second question was cryptocurrency. Okay, which isn't what we covered in today's material. And I was just hoping that the content we cover here does not confuse anyone. But I'll comment on cryptocurrency to satisfy the person who asked the question. But please, I hope no one will be lost, will be mixed. So put simply, cryptocurrency is a currency, it is money. You use it to buy and sell. It's like kwacha. It's like your dollar. It is a currency. The only difference is that it is not a currency that can be printed like kwacha or dollar. What it then means is that if you can't print it, it is better at storing value. Remember, a currency is a store of value. So cryptocurrency is better when it comes to storing value. What influences the price of the currency is the same thing that influences the price of any currency, whether it be the kwacha or the dollar, which is demand or supply for that currency. So the more people have demand for cryptocurrency, the more we will see its value appreciate. If more people, so in short, more people should be able to buy things with cryptocurrency. They should have a need for it. If people don't have, so if you're invested in cryptocurrency, you should be worried if you hear that governments are banning the use of cryptocurrency, because it means that the population in the world that should create demand for the currency is reducing. It simply means that there will be less demand for the currency and its value will drop, and you will lose your money if you're invested in cryptocurrency. So the short answer there is, what influences the value is demand and supply. Is cryptocurrency good? It requires a personal discussion to understand your circumstances. But if you're an aggressive investor, that could be one opportunity you can look at. It's more risky because that's investing in currencies and it's a digital currency. It's not fully understood around the world. So you could easily lose money. I would recommend you start from easier products that still generate good returns. The last question was on, I've forgotten the last question. Maliwe, just remind me. The last question, there were 3 questions.
Okay, Davy.
Hi.
Yes, I was saying the person was asking if you know they can, what accessible online resources they can use.
Okay, perfect. I remember.
Yes.
So for our local stock market, information is scarce, but you can access information on our local stock market from the Lusaka Securities Exchange website. So if you go there, you'll find, and they're quite elaborate actually. They've listed the companies that are selling their shares there, and there's information with regards to the performance of those companies. So that's where you can get. For the offshore stock market, the platform that I think is good, that I also use if you're trying to understand how markets are performing, is Bloomberg. So Bloomberg is very good when it comes to discussing or putting up information on different stocks international. I mean, it's a business platform. So it's very good with, showing information on stocks and even their performance. The screenshot I shared on the mutual fund, I got that from Bloomberg. So it's very good. If you're interested in accessing this information directly, you can go to that site, bloomberg.com, and you'll be able to see that information. Alternatively, you can speak to an investment advisor. And there's another radio station. I do give comments there on commodities and different investment products. It's called Money FM. I also recently learned of it, but it's quite good. If you can tune into it, and I've lost track of what the station is. I don't know if it's 93.7 or 0.3, but if you can look out for it, it actually talks about money. It's quite good and quite useful. So you can also use that. You can listen into that radio station. It's quite informative.
Thank you for that, Davy. So I think one other question is, are bonds the same locally and internationally? You mentioned differences with the shares.
Yes, so a bond is a bond. It's a loan. Internationally, what it would mean is that you are simply lending your money to a company that's international. So you'd be lending your money to a company like Barclays, like HSBC, like Macquarie Bank. In short, you'd be lending your money to an international organization. And normally when we use the word offshore, we simply just use it to denote a change in currency, that you're not using kwacha. It's in a foreign currency, which could be dollar or pound. The principles and the mechanism is the same. So that company that you're investing with, you expect coupons, which is income or interest, and you expect to get your principal back at a maturity date. And those are set out in the contract. Locally, and I should mention this, if someone says, I'm investing in a bond locally, the market currently only has the government bonds. So if you're going to invest in a local bond, you'll be investing with the government. You'll be lending your money to the government. That's what you'll be doing.
Okay, thank you for that. So as I mentioned, if there are any more questions, you can just raise your hand or indeed type them in the chat box. So Davy, with your permission, I'll also share these slides because someone has asked about the slides. And then I'll also share your contact, if that's fine, so that, outside this forum, people can chat to you and maybe you can help them out with any parts that they were not clear with. Is that fine?
That's okay. Perfectly fine.
Yeah, so one other comment from David Singini is for short-term investments of a year or two to grow money, which would be better between using a fixed deposit with a bank or non-banking financial institutions or a treasury bill? If you want to grow money, which one is better?
Okay, that's
You
a
know,
very
like
good question.
yeah.
That's a very good question. Just to add some context to that, there will certainly be opportunities in life where you want to make money for a short term, meaning you've got other commitments, maybe in 2 years' time, so you don't want to lock your money away for a long time, or you don't want to put your money into an asset that grows money over a long term. So from a short-term point of view, if you can speak to your bank and negotiate a rate that is good, a fixed deposit should offer you competitive returns. However, treasury bills also offer good returns. I think you can fetch as high as 27% on a treasury bill. That's per annum, which is decent. The only thing you need to take note of, which is something we haven't covered here, is that treasury bills are subject to tax. The income you earn on a treasury bill is taxable. There's a withholding tax that is charged of 15%. So just to make sure that, since this is a broad forum, just to make sure that we don't interpret it as a tax advice, you need to sit down again with an investment advisor and they run you through the taxes applicable. There are no taxes on fixed deposits, but there are taxes on treasury bills. So when you take out the taxes from the treasury bill, depending on the period, it could be 3 months, 6 months, 9 months, or 12 months. So depending on the period you go for, it could impact your returns when you're comparing it to a fixed deposit. But otherwise, both products are good for the short term. And normally, treasury bills would give you better returns. But you need to sit down again with an advisor and just work through the numbers and make sure before you place money, you're quite clear with what your costs are, what the taxes are, and what your return will be.
Okay, thank you for that. I'll allow Mutinta Muchanga to ask a question or give a comment. Mutinta?
Thank you very much. Thank you very much for that presentation. I wanted to find out if it would be wise to make multiple investments, seeing that you said the markets are unpredictable. For instance, let's take a look at those that have invested in real estate in Lusaka. Currently, the rental prices have dropped. Then if you look at situations, maybe when one invests in the stock market, some companies internationally, they are gaining in terms of share prices, but locally in Zambia, right now the stock market is doing very badly. So I just wanted to find out if it's wise to make multiple investments. Let's say if you want to get shares, you buy in multiple companies because it's unpredictable. And then those that want to do, let's say, real estate investment, if it's in Lusaka, you don't focus in one area because let's say maybe if one wants to build some apartments, let's say in Roma or Charleston and whatever, you don't focus in one area. So I just wanted to get your take on how to go about making multiple investments. Thank you.
Absolutely. I think that's a fantastic question. The safe way to invest is to diversify. And by diversification, we mean spreading your investment in different assets. And it works very well. Like you mentioned, there could be times when one sector or one area of the economy is not doing well, then the other area of your investment could be doing well. So the two could net off and give you returns. So the answer is yes, it is good to invest. I'll add a ride on to that, a rider. When you, what also works is understanding the market very well and having a good outlook for the future. In my experience in investment advisory and strategy, I have come to appreciate the importance of limiting yourself to an area and understanding it very well, knowing when to exit and knowing when to stay invested. So in short, you need to know which sectors are good to put your money into. So I'll give you an example, just to put that into context. Right now, we know that the airline industry is not doing well, because of COVID. So people are not traveling. So the airlines are going through a very tough period. So should you invest in the airline industry now, or should you invest now because it's cheap, or should you invest in airlines, in oil and technology? Should you diversify that way so that when airline begins to peak, you can begin to pick up as well with the industry? The view, and this is where I think investing becomes interesting, because, and I honestly believe you have to definitely have an advisor you speak to who spends more time in the markets and understands these things well. The same way someone would see a doctor for specific medical treatment. I think that understanding and appreciation of the market is important. So if you look at technology in this period as a sector, so the technology sector, as we are locked down, we are using technology infrastructure. As the world begins to open up, technology will still be a very dominant part of our life. So people are going to stop traveling. They're going to use more technology, for meetings and so on. So we'll see some reduction in the airlines, which is also going to impact oil. But the point here is that technology is a very good place to put money. And in terms of the outlook, if you look at the next 2, 3, 4, 5 years, that sector will continue to receive a lot of investment, because almost all new developments we're receiving or seeing on the market depend on technology. So if we're sitting, or if you're making a decision, should you make a decision to take a bet on technology sector? Depending again on your circumstances, your risk profile, one person may choose to simply put all their investments in that sector because they understand the sector quite well. They've seen the past performance and they appreciate the outlook. So they know over the next 5 years, I think this sector is okay to put money into, and they can take that position. However, I think the well-known, tested strategy when it comes to investing is to spread your eggs across many baskets. However, it's also important to note that that strategy does not create riches compared to those who take directional risk. Directional risk, which is they just say, I understand this area, let me pump in my money into this sector. And they take a risk. That directional risk normally results in more wealth creation in the long term, whereas the one who spreads their eggs in many baskets, or their investment in many baskets, minimizes the number of shocks they will experience when it comes to loss. Because like you correctly mentioned, when you're invested in one area and it doesn't perform well, the other area performs well, and they're more or less net off. So it's a safe approach to investing. And when someone is starting off, I would highly recommend that they should diversify their investments until they get to a point where they fully understand the investment markets and they can take directional risk.
Thank you for that, Davy. So one other thing is, what is your comment on financial cooperatives?
Okay, so financial cooperatives, is it financial institutions?
So I'll ask, I'll ask Priscilla to just clarify when you ask your question on financial cooperatives.
Would it be banks? Is it in reference to banks, microfinance?
Priscilla? Okay, as we wait for Priscilla to just, clarify, I also wanted to just find out, Davy, from you, in terms of preparing for retirement and the like. We look at markets like or economies like the US, where they have these pensions, sort of, Roth IRA and the like. Do we have a similar structure in Zambia, where you can be putting money away, and at the end of the day, or when you're retiring, you could sort of just withdraw if it's a lump sum, or and things like that? Do we have something like that?
Yes, so you can do that through an insurance company. So insurance companies do offer some plan for you to a pension contribution, and I think most private companies for their staff are doing that. So they've got NAPSA, which is a government requirement to help us prepare for retirement by saving a portion of our income, which is 5%, and the employer puts 5%. But we also have insurance companies or pension funds that allow you, I think if you go there and speak to them, you can make a contribution to them and just save your money if you choose to go that direction. However, alternatively, you can as well make investments. So use your investment as planning for your retirement. So invest into a product, see it grow over the long term, just watch over it and observe, you know, the market very closely and use that investment as your retirement package. I think that works well in the long term.
Okay, all right, thank you. So I don't know if Priscilla is ready to clarify, but I think if I follow her well, in terms of financial cooperatives, we've seen a number of financial cooperatives that have come up on the market, especially in Southern Province. I know that they have all these cooperatives that you save money in, and then after maybe 6 months or 9 months or 1 year, you get some benefits. There are quite a number, especially in Southern Province. Maybe those are the kind of cooperatives she's asking about, and maybe you could give a comment on that.
Yes, so what makes something good or bad is how the risk is managed. That's very important to note. Is the risk understandable? Do we understand how it operates? And is the risk managed properly? That's critical for any investment. You need to know how is the risk managed. So if you're going to be contributing money to some cooperative, I think the first thing you must be aware of is that, you know, the money can go missing. Or in short, the person, if it's being handled by a person, they can steal the funds away. That's one. So you need to make sure you've got mechanisms in place in that cooperative to ensure, and I think this also applies to village banking. You need to make sure you've got mechanisms in place to ensure, one, the money is not stolen. The second thing is that most of these cooperatives involve lending money to the members of that cooperative, which is a good thing because it empowers the members. The risk there is the same way it is with bonds or any lending investment, is that the person you've given the money to can default. They may not have a proper place to invest that money and they may end up defaulting. So you must have mechanisms in place to ensure that if there's a default, you have some recourse. In my experience in the lending market is that it is very difficult, not impossible, but it is very difficult to recover funds when someone defaults, especially in these schemes. You can go to the police and so on. The process is tedious and it's cumbersome. And what you just want to make sure is that you have got good people in the cooperative who are honest, so that when they receive this money, they can return it back, and that the good people as well do not misappropriate or steal the money and just say, look, do what you want, but I have no money to pay back. So I think for cooperatives, that's how you look at it. The principle is good. I think it's good to empower people. I hear some schemes can even do as high as 10% per month. The only thing you should manage there is default, purely. Otherwise, in terms of the idea, it's good, just manage default.
Thank you very much for that comment. So I think I'll allow any last few comments. I can see Oliver Kauma has raised his hand. So Oliver, please go ahead.
Hi, Davy.
Hi, Oliver.
Hi. Thank you so much for this informative presentation. I just wanted to find out, you've listed a number of investment options, and currently looking at the prevailing condition globally, what investment options would you advise if one was to decide to invest at this particular time in the world?
Okay, that's a very good question. So during COVID, where is the opportunity? So there are two areas we can look at during COVID, and I mentioned one of them. We look at what's driving the economy during this time. So the first thing that's driving the economy is what I covered, and is technology. So a lot of what's happening involves technology. Right now, I mean, previously we would have arranged for a venue, we would have met, and we would have done this presentation face-to-face, but now we're using Zoom. So Zoom, and I'm sure we've seen it in the news, the valuation of the company has gone up because it's useful in the market right now during this time. So if you're going to invest money, I'm not promoting, Zoom, but what I'm saying is the technology sector, which includes Zoom, Amazon, Apple, Microsoft, all these other tech companies, and you need to understand how they're performing. But the sector is a good place to put money if you're looking for a return. And it will be, I think, for a few more years to come. The other place you can put money in, if you look at what's happening right now during these times of COVID, is the area where you operate, the healthcare industry. So you notice that there's a lot of medicine that's being made available. There's a lot of equipment that's being purchased, these sanitizers, these chemicals. So the healthcare sector right now is performing well. It's a very good place to put money if you're looking to invest your resources. You can look for a company that's operating in the healthcare sector, pharmaceutical, or so on, and just check its performance and then get a view on the outlook for the next 12 months or 24 months, and then you can invest in that sector. So two key sectors that are good. And remember, within the sector, there are multiple companies, but I'm giving this view from a sector point of view. It is the technology sector and the healthcare sector. These are very good places you can invest your money in.
Okay, thank you very much. Unless, are there any more burning issues or comments? I'll just read, I think, one comment from David. He says, those that can download that booklet on T-bills and bonds as offered by Bank of Zambia. It also shows the taxes that are involved as the presenter highlighted. So thank you very much, Davy, for the presentation. I know we've overshot on time. Instead of doing 1 hour, we did about 1 hour, 20 minutes. But thank you very much for creating time for us. This has been a very informative presentation, at least for me, and I believe even for my colleagues as well. So for any questions or things that they might have, I'll share your contact as I said, Davy, and we'll see how it goes. One other person I think wants to ask is Joshua Chasimpa. Joshua, you can go ahead. Probably, maybe that will be the last question.
Hi, sorry, this is Brian. I'm using my my son's platform. I'm Dave's friend. He asked me to join. Yes, he asked me to join. A very good presentation, Dave. I thought I should just maybe add with the options that Dave has given on the bonds, especially if people may have interest in investing in those. I think it's also important to take cognizance that in the market there are two avenues that you can access the bonds. So you can access them on the primary market, which is Bank of Zambia, and you can also access them on the secondary market. Now, on the secondary market, there are different institutions that are able to allow you to get that. So there are some banks or some financial institutions. However, what is pertinent, I think, to add, and why I bring that avenue, is that on the primary market, when you make an investment, usually it will be for purposes of long term or for the period that is captured. Now, what that implies is that should you want to pull out of that market, say push comes to shovel, it's a bit difficult unless otherwise. Why? You find...
Push comes to shovel.
Oh, yes. Should some pressure or some trouble or problem come your way, and you're thinking, I need to break this investment. On the primary market, usually it's difficult to pull out unless otherwise. On the secondary market, it's a bit easier. Why? Because the platform is made in such a way that flexibility can come out. As usual, taking into account the risks that Dave brought out, such as liquidity risk and so on, but it has got a more flexible side to it. So it also falls on treasury bills. So as you're looking at those interest rates, as you go on Bank of Zambia site, you see that the rates might be very attractive. but take into account that should you want to pull out of the market, on the primary market, it's usually very difficult. While on the secondary market, it's easier. There's more flexibility compared to the primary market. Why? You find that Bank of Zambia, for example, which obviously represents government interest, might have a fundamental objective like how do we manage inflation? Okay, so in managing inflation, they would want to pull out some certain funds off the market so that they can mitigate liquidity that sits in the market. So if one comes in and they want to pull out, buy in, then it would go against that objective. But on the secondary market, you find that it's for purposes of, say, maybe profit, giving some good customer service to people and so on. So that will not sit as a fundamental thing driving the agenda. So I thought maybe I should just add that bit, that as Dave has said, engage an investment advisor so that you can have a full scope of where you want to put in money, what are the risks that are coming in, how quick can you access this money, what can you do with it, and so on. Yeah, thank you.
Thanks a lot for that, Brian. And let me just mention this as I close, is that I hope we haven't got the impression from the presentation that one asset is better than the other and one is bad, or real estate is not good. For the record, we have not said any asset is bad or real estate is bad. What we have demonstrated, or what I've demonstrated here, is that different assets work for different objectives. It depends on what you're trying to achieve. All assets are fine, they've got a purpose. They all have a purpose that you should use to achieve. So if you're looking to grow capital, there are assets that you should use. If you're looking to get income, there are assets that you should use. And I just hope that beyond this, you can engage and ask any questions you may have. There are no charges, you can ask. There's a page that's opened on Facebook called Davy Nanduba. You can also access it. It's a new page. So you can just like that page, and then you have a lot of investment information being shared there, and we can follow through, you can discuss and engage. And I just hope that this is not the end. This is the beginning of a journey together where we can help ourselves make these investment decisions. Thank you.
All right. Thank you very much, Davy and Brian, for the presentation. It was well thought. I feel I have more knowledge now, and we will continue to engage outside this platform. And as has been said, Davy has a Facebook page, Davy Nanduba. I think people will like it, and they'll be able to ask questions. I'll also share the PowerPoint slide, and because this was a recorded meeting, I'll make this recording available to those that may not have been able to join us. I'll also share your contact, Davy. So thank you very much. So I don't know if you have any last words, Davy.
No, just to thank everyone for your time. I know time is not easy to access, especially in the times we're in. I don't take it lightly. I'm really humbled and appreciate that you spared some time for us to engage, share knowledge together. We'll continue conversing, and I just really hope that this information was useful.
All right, thank you very much. So I think now it's 5:30. It was a good discourse. I will end the meeting at this point, and all other queries, I think we'll take them up later on. Thank you very much, everyone, for attending, taking some time off your busy schedules. So at this point, I'll end the meeting. Thank you.
All right, thank you.